It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today we have a guest. It's going to be pretty exciting. I think you guys will see what I'm talking about. So first of all, we have Richard Goldberg with us. Richard, welcome to the program.
Thanks for having me, Ference.
All right, you're welcome. And like you said, folks, I like to bring in guests who have an experience with the personal bank concept. And Richard's is a little bit unique because he's coming at it from the insurance agent, financial advisor side of things. And so, Richard, if you don't mind, because here's the question that I want to address today. We're going to do this, folks, today, because when I introduce people to this concept, the number one question I get is, well, why haven't I heard about this before? And so Richard and I are going to kind of answer some of that. But before we go there, Richard, can you tell us a little bit about yourself, your background?
Absolutely. So I started in as a financial advisor right around 2000. And, the reason I decided to do it was because I'd worked in the corporate world and corporate sales and really wanted to have an opportunity to be self-employed. Didn't really have a direction, didn't really know where I was going, but, decided, hey, you know what, I'm going to go ahead, jump in with both feet, and, went ahead and got started in regards to just selling transaction, life insurance, health insurance, disability insurance policies. So, and my whole entire framework in regard to my practice has been insurance-centric.
Okay. Okay.
Yeah.
So, and you've obviously developed a business, a number of clients over the years, right?
That's correct. My company is my firm. I'm an independent firm. It's CP Advisors. CP stands for Capital Preservation.
Okay.
The motto is not how much money you make. Ultimately, it's how much money you keep.
That's a good point.
Yeah. So it's all about asset protection, helping people grow money in utilizing, the insurance vehicles.
Right.
Permanent life insurance as well as annuities.
Sure.
So that's and then I do some work in regard to estate planning as well.
Okay.
Yeah.
Okay. Excellent.
Mm-hmm. Sure.
And so obviously you were doing that type of business with a number of clients, or like you said, since early 2000s.
Yes, that's correct.
And like most advisors out there doing, insurance agents and such. And then sometime, I guess fairly recently, you were introduced to the personal bank concept. Is that right?
That is correct.
So,
probably I think one of the things that I did learn is understanding collateralization, but it was more in the format of taking loans from the general fund of the life insurance company, utilizing your cash as collateral, and then being able to, utilize that for maybe major capital purchase, maybe for college funding, maybe for retirement.
Now, I'm sure a lot of our listeners will understand what you mean by collateralization, but for those who may not, what do you mean by that, Richard?
Yeah, so basically what we're looking at is, we talk about collateralization. What we're saying is that, I guess a typical example that your listeners would be familiar with is if I made a purchase and I needed to collateralize that, maybe I had to put up my home as collateral.
Okay.
To make sure that if I defaulted on that loan or that type of purchase.
Like a typical mortgage.
Like a typical mortgage, right?
Okay,
So that so in essence, I would have, the bank would have the access to, being able to, take the home if that were in the case in that situation.
And you're basically applying that into financial products then, right?
That is correct.
That's the principle.
Yeah, and the idea there is to say, hey, listen, if I'm able to have that money that I'm collateralizing in a life insurance policy, for example, and it's still participating.
Okay.
So it still will be making money.
Okay.
Right? That's the idea. So, to me, that is a great, I think that's a great way to do, in essence, to leverage, but we're not seeing an arbitrage in regard to that.
Okay.
In essence.
So in other words, it gives you access to funds and such, but there's really not any arbitrage.
Not an arbitrage,
Right.
no.
Now, of course, when you got introduced to this concept, the personal bank concept, what was different in your mind?
The thing that's different is, and I didn't know, kind of you talked about earlier, the issue that, or the idea, I should say, of being able to have a correlation between a bank and an actual permanent life insurance policy and the ability to see positive arbitrage. I just wasn't aware of it. And I think the only way you find out is, Blaze Jacobson with Penn Mutual, he actually, said, hey, you need to talk to Ferentz, because he knew my passion in regards to
Right.
really trying to research and just, learn and get better at what I'm doing. And, I think that's like anything else. I mean, if you're not looking and if you're not passionate about it, chances are you're not going to hear about it.
Yeah, and I think that really kind of and yeah, shout out to Blaze. He's an awesome dude.
yeah, he is. I'll tell you, Blaze has been great in regards to, designing and kind of, putting a blueprint in regard to a lot of these, when we present. So, yeah.
And those of you that are listening, that won't mean anything to you, but us as advisors, it means a big deal when we have that support from the company that can help us accomplish some of these goals that we want to accomplish with our clients, obviously. So,
Absolutely.
But I wanted to get back to a thought you just shared was, you weren't familiar with the idea of bringing in the bank line along with the cash value of the policy. And I find that to be very, very common with advisors.
Yeah, I mean, it's not something that's being talked about in the advisory community by any means.
I haven't seen it anywhere.
No.
And you'll see this too, I'm sure, but I get asked, one of the number one questions I get all the time from listeners, from potential clients is, once they start looking at this whole idea, they're like, wait a minute, why haven't I seen this before? Why didn't my financial guy tell me or gal tell me about this before? And, there's a lot of reasons behind it, I've found, but I think the biggest one is just, it's truly a lack of familiarity, lack of knowledge. And
absolutely. And I think one of the things that, and I kind of go back for a moment when I was saying, trying to research or find out more, to me at least, is, I want to be able to offer the best, products and services and value that I can. And, to me, that's what I have always strived to do.
Right.
When you're independent,
right.
And you're not getting kind of the, maybe the tutelage and mentorship from the company.
Right.
You have to go and do this on your own. And so for me, though, it
you
allows
have to be
me.
more. You have to, if you're independent, you have to be more self-reliant.
Absolutely. And
right.
but it allows what it's allowed for is me to be different and
right.
unique, because I'm bringing strategies, have ideas, I'm solving problems, even problems that they might not even thought existed, that they weren't aware of them. And that really the whole goal in regard to why I've got into this from the very beginning is to try to help people. So
in terms of the personal bank concept, again, bringing the bank line in with the cash value insurance policy, what is it you see is different than what, say, you were familiar with or were doing before?
Yeah, I think the main thing is, like I was saying, if you're taking a loan from a policy, don't get me wrong, it is efficient, but there's no arbitrage. I mean, basically, it's just a wash loan. Whatever.
And expound upon that.
Well,
arbitrage. Because I get asked that all the time. What is arbitrage?
Yeah. So basically, what we're looking at arbitrage is if we have a credit line, and let's say we're utilizing, bank rates that are for a low interest bank rate that's for short term, and let's say it's at 3%, and we're looking at a policy that's paying 5.7%. That's the dividend that they're paying, that they've been paying since 150 years. Right. If we're utilizing the bank line to pay for things, we're seeing an arbitrage of 2.7%.
Yeah, it's actually 275.
275. Yeah. So
Yeah.
yeah. Well, you're the guy who gets in all the devil in the details. Geez, Ferentz. But no,
anyway,
listen. The bottom line. Let's face it, though. 2.75 compared to 2.7. That's compounding uninterrupted for a long period of time. That makes a difference.
I have a client of mine who's a Mensa member and all this stuff, and I was doing a workshop. This was some years ago, and he stood up in front of the crowd, and there was about 60 people in the room, and he goes, if you can get 1% positive arbitrage, jump on it. That's money in your pocket you wouldn't have any other way. That's how he
absolutely
stated it.
And I think also, just in regard to my personal conversations with you, my own personal finances, bringing to the attention some ideas that I had. And you said, even, kind of slapped me upside the head, not
in a nice way,
not physically, but literally, right?
Yeah.
But said, hey, quit thinking like an agent, and think like a someone that understands, in a wealthy mindset, which we all want to have that mindset, right? A wealth accumulator, right?
And I think, and just so you know, and you're gathering that from me as we've been starting to work together. Full disclosure, we now work together, right?
Absolutely.
We didn't until recently.
Yeah.
But I come at this from. I always tell people, yes, I'm a financial person, I'm an insurance agent, all that stuff. But my background really is as an entrepreneur. I've owned 4 companies. I'm in the process of starting an FDIC insured bank. So I'm an entrepreneur thinker, and first and foremost, and then my secondary thinking is from a financial standpoint or financial advisor. So one of my issues all the time is, like you just said, I've worked with agents for decades. Stop thinking like an agent. Start thinking like an entrepreneur or a wealth accumulator.
Exactly.
Right.
Exactly. Well, I mean, the thing is like when we sat down and kind of broke bread and got to know each other a little bit.
Right.
You know, you fit into the, you know, you are another mentor and another, you know, leader that I have found, and that's been a huge success in my life during my entire career. Like you said, when you're independent, you're kind of on an island, and you got to seek out the people that can really take you to the next level.
Right.
And so, and just, you know, kudos to you. I mean, it was kind of interesting because we had a call. Maybe I'll just kind of, maybe we talk about it a little bit.
Well, yeah, what we're going to do is, folks, and by the way, at the break, I'll give Richard his $20 for saying that.
Right.
But as
you got to give me more than that, man.
Yeah, there you go. I'll give him a C note. Right?
Yeah, right.
All right. Ben Franklin.
Yeah, there you go.
But as I was going to say, yeah, we're coming up on a break here pretty soon, but we'll get into I'm going to encourage folks to stay tuned in the next segment, because some of the questions I'm going to ask Richard is like some of the situations how he's using the Your Personal Bank himself personally, and then also with some clients, because I know this for a fact, Richard, just some of the stuff you've said, if somebody's listening right now, they're like, okay, this sounds interesting, but they're not fully getting the whole picture yet. You know what I mean?
Absolutely.
So,
yeah, we'll break it down
yeah.
and kind of step by step it. Absolutely.
Absolutely, yeah, because it's, as I state all the time, you've heard me say this, it really truly is, for most people, a paradigm shift in thinking about money.
Absolutely. The difference, in my view, is between sacrificial economics and beneficial economics. When you think about it.
What do you mean by that?
Well, I mean, when you think about it, most people today, unfortunately, are paying a lot of interest. They're paying interest in regard to credit cards.
True.
They have interest in regard to car loans.
Right.
And the idea of being able to change that, and I consider that to be sacrificial economics.
I like that.
But I think when you talk about beneficial economics, that's right where positive arbitrage fits. What can I do to have my money working for me? And if I have my money working for me in an environment that I'm going to be able to, compounding interest, right?
Sure.
The greatest mathematical invention in modern history. I mean,
Probably.
It's considered, right?
Sure.
Albert Einstein, right? They
That's
asked him, they said, Albert, do you believe in God? He said, no, but I do believe in compounding interest. So
there you go.
My point there is just saying, if we're in an environment where we're truly compounding uninterrupted, you can't get any better than that.
All right. Well, stay tuned in the next segment. We're going to get into this further. And if for more information, of course, contact us at 866-248-4422 or yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we have a special guest, Richard Goldberg. He's been sharing with us some of his experience as a financial advisor, insurance agent for the last, 20-plus years, right, Richard?
Yes.
So, and I was going to say, if you missed the first part we're going to have Richard with us the whole show, but if you missed the first part, go to yourpersonalbank.com. You can listen to any of the previously recorded shows anytime you want, so you don't miss anything. But Richard was sharing with us a little of his background, being in the financial world all these years, and then recently was introduced to the Your Personal Bank concept, right?
That's correct.
Yes. And so one of the things we really started to get into was the idea of collateralization and positive arbitrage. And I can say this, that those are some of the most common questions I get from folks who are looking into this. The words sound intimidating for a lot of people and sounds complicated, but frankly, as I share with folks, they're really not. They're basic financial literacy concepts, and they're very simple. So what I want to do, Richard, is maybe use a couple of examples to kind of help people better understand the power of collateralization, positive arbitrage, positive cash flow. You're using the personal bank concept yourself personally now.
Yes.
Explain to us what you're doing and how it's going to work.
For me, I actually am in the process of selling my home.
Okay.
And, what I'm going to do is the proceeds after the expenses and after paying,
right.
If there's capital gains or taxes, whatnot, I'm going to utilize a big chunk of that money, if not all of it, to put into my own personal bank.
Right.
Which is a whole life
Dividend,
life insurance,
a
dividend
paying
paid
policy.
policy.
Right.
And then I'm going to use that on when I go ahead and buy. I'm going to use the credit line and use the arbitrage, collateralize the money in the policy,
Right.
and utilize that for my down payment. Utilize the money from the credit line to basically, instead of having an opportunity cost on that money, which means that there was no opportunity to make any money once I went ahead and sent it to the financial institution.
Right.
It's gone.
Right.
Now I have the ability to see arbitrage.
And what are you going to planning to do with that money, for example?
Well, I mean, I think what I'm planning to do is, for me, is continue to just take money and all of the money that I continue to earn for my lifestyle, whatever, put it in the policy and continue to let that money grow. And when I see opportunities to be able to see, maybe real estate investments, maybe for the future as far as, some other ideas that I may have, to continue that process.
Right.
So, yeah.
So
but basically, but just in regard to that example, whatever that amount is, haven't gotten there that far, but I'm taking a chunk of money, utilizing for a down payment, utilizing the whole life dividend paying policy of 5.75.
Right.
The bank obviously is at let's say 3.
Correct.
Right. Now I'm seeing a 2.75% arbitrage on that money that I put down in my place.
Which means if you're earning 5.75 on the money,
correct,
and you're getting charged say 3 or 3.25, depending on which bank we're dealing with, from the bank,
right?
You get to keep the difference, right?
I'm keeping it,
right? And
instead of spending it,
right? Well, and again, the takeaway I always tell people is, Richard, that's on money you spent.
Exactly.
That 2.5, 2.75 positive cash flow, positive arbitrage. In other words, you took that money and say bought a rental property or something, right?
Correct.
So if you left it in the policy, you'd earn your 5.75 dividends, right?
Yes.
If you access it, and I always help people understand this better, are you taking the money from the insurance policy or are you taking it from the bank?
Yeah, I'm taking it from the bank.
Right. That means the money's still in the insurance. The insurance company still has all the money, right?
That is correct.
Means they're just going to pay their dividends and do what they do, right?
Yes.
Compound for the rest of your life, right? Then you decide to access it to, say, buy a rental property, like you said, and you get whatever return you get on that investment, whatever it is, but you're picking up 2.5, 2.75 positive arbitrage. You keep the difference.
Right. And that, in essence, if I'm looking at a return on my investment of 10%, now I've increased that 25% because now I'm looking at 12.75%.
Right. I tell people this all the time, that if you take any investment out there, and you can increase the rate of return on that investment, like you said, by 25%, what would that do to your portfolio?
Makes a difference.
Every year over time?
Absolutely.
In a decade, you'd have 25% more money, wouldn't you?
You sure
without
would.
Compounding, right?
That's right.
So one of the statements I always make is, look, Richard, you could do you could take the proceeds from the house sale that you're doing, and you could take that and invest it in a rental property and get your investment return that you get. Or, like you said, you could put it in the policy, then access the funds from the bank line and invest in that rental property and pick up another 2.5, 2.75, or, like you said, increase your rate of return probably by 25%, give or take.
That's it. I mean, it could be more efficient than that.
Could be more, could be less, but
from efficiency purpose, if I'm really looking at it from that in regards to from the economic side of it, can't get any better than that.
And that's an extra 2.5. Some people say 2.5%. That's not a lot of money, but that's, again, it's on money you spent. You allocated it elsewhere, right? Like
that's
you
right.
said, the lost opportunity cost you mentioned.
That's right.
You gave that money to somebody to buy that house, that rental property, right? So that money's gone and you're out of your life forever, right? You got a property out of it, yes, but the cash is gone, right?
That's correct.
So that cash will never grow, earn any interest, or do anything for you ever again, right?
That's right.
Here, you still get some benefit from it, right?
Yeah, and that's why, to me, when I was introduced to it, now it took a little while for that paradigm shift for me.
Right.
But now I get it.
Right.
And I think like anybody else, you got to listen to the show. You got to listen to the podcasts, the recordings, the interviews that you have on the website.
Right.
And you got to dive in and you got to spend some time.
Right.
Because, and of course,
Educate yourself.
educate yourself, but also, I mean,
Right.
you have, Ference, you're there to reinforce and, explain and make sure that no question is left unanswered. So,
And since Richard brought that up, where do you go? Yourpersonalbank.com. There's like 2 years of shows, content of this concept that's on the website. All the different shows have different titles. You can look at it, research it, learn. I tell people, look, if you listen to a few of the shows, you're probably going to get 90% of your questions answered, right?
that's right.
And that's kind of what you did when you first looked at this, right?
That's what I did.
Yeah.
Especially the interviews that you have with the different lenders.
Right.
I thought that was very informative.
Right.
And just in regard to, your show and talking about big picture in regard to where we're at today as a country,
Mm-hmm.
where we're at in regard to, from a, financially, and not only that, but just, some of the things that, to me at least, you're really addressing issues that are real issues that people need to be aware of.
And yeah, that's a whole nother topic, but yeah.
Yeah. Yeah.
If somebody wanted to contact you,
Sure.
Richard, how would they do so?
So the best thing for them to contact, once again, my company is CP Advisors,
Mm-hmm.
and they can call me. I mean,
How would they reach you?
And my number is 602-488-2379.
Okay.
And that will, pipe directly to me. And, like I said, I'm a one-man show. But absolutely, positively, they can contact me directly.
Excellent. So I'm going to encourage folks to stay tuned in the next segment because there's a couple other things. There's something that Richard brought up on his personal situation, what he's going to do with this house sale, the proceeds from this house sale, using the personal bank concept to get the additional positive arbitrage, the extra cash flow, and buy real estate. But there's something he doesn't even realize yet that I'm going to share with him in the next segment that'll actually enhance his returns even further. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and I'm here with our special guest, Richard Goldberg. If you missed the previous segments, Richard has been in the financial industry for over 20 years. And welcome again, Richard.
Thanks.
And he's been sharing kind of his experience in terms of as a financial advisor, insurance agent, all that kind of stuff with your own company, right?
That is correct.
And then was fairly recently introduced to this Your Personal Bank concept. And we've been talking about, why a lot of financial people, financial advisors and things are not familiar with this. So if you did miss this, I'm going to tell you what we were talking about earlier. Go to yourpersonalbank.com, check it out. You can listen to any of the previously recorded shows. But we've been talking a lot about positive arbitrage, positive cash flow, collateralization, Richard. And you brought up an example yourself of you're selling a house and what you're going to do with the proceeds of that money to gain this positive arbitrage. But one thing you mentioned I thought was interesting, and we just talked about this on the break, is Richard said he's going to take the proceeds of the house sale. Obviously, he wants to take that money and invest it probably into like a rental real estate or something like that.
Right.
Yeah. But he said, he's going to pay the taxes, capital gains, all this kind of stuff. And and here was my thought for you, Richard.
Okay.
Obviously, I tell people this all the time. Look, if you sell a house and you get some proceeds or you have some money, you want to use that money to invest, you can do that. Obviously, you have that option and get whatever return you get. But if you use the high cash value policy to get dividends and then access the funds from the bank line, you get the positive arbitrage. We understand that. And now you increase your rate of return on your investments, right?
That's right.
Because you get both, right? But you mentioned, you were going to pay the capital gains taxes and everything and then invest into the policy to get the dividends. What if you, instead of paying the tax, because the taxes aren't going to be due until probably April of next year, right?
True.
Yeah. So if you sell the house, let's say, I don't know, if you sell it this year in 2021, the tax isn't going to be due till April 2022, right?
Right.
What if you took the amount, whatever the capital gains was going to be, what if you took that and funded that into the policy also? And then in April, you access the funds from the bank line and pay your taxes. What would the difference be?
Well, more arbitrage.
Right. In other words,
I mean, there's lost opportunity on the money that I'm paying out of the, for the taxes.
Yeah, because you mentioned the
if I paid out of my pocket, right?
Right. So my thinking was, you mentioned you're not sure exactly, but you think the proceeds are going to be somewhere around $100,000. from the house sale, right?
Yeah. Yep.
And if it's a long-term capital gain situation, you're going to 15%. So you're going to have to pay about 15 grand in taxes, maybe, right?
Right.
Well, do you want to earn interest on 100 grand or 115 grand?
Why not earn 115?
That's my point.
No.
My point I make to people all the time is whenever you have an expense, like taxes or anything else for that matter, you can pay the tax, you can pay the bill, you can buy the asset, buy the item, and the money's gone forever. You brought it up.
Mm-hmm.
Lost opportunity cost now that you may pay the tax, get rid of the bill, or buy the item, but the money's gone forever, right?
That's right.
Or you can put it in the policy and then access it from the bank line and pay the tax or buy the item and still pick up 2 or 3% positive arbitrage every year for the rest of your life.
Not a bad deal, Ference. Not a bad deal at all.
And in 20 or 30 or 40 years, how much more money would that be in your pocket?
Yeah. I mean, you look at these type of concepts, and once again, it's just a question of being able to apply them and being able to understand.
Right. And if you sell this house, you're going to have to pay the tax, right?
Gonna have to pay it.
You're not going to get around that. And we're saying, look, pay the tax, but why give up that money forever? Why give up the ability of that money to earn anything for you forever?
Right.
Hey, if it's a couple percent, hey, that's 20% more in 10 years.
That's right.
Without compounding, right? So, we're gonna in the next segment we're gonna talk some more about a couple of client situations that Richard's working with recently with some folks. But I just want to say one before we get there. So I'm going to encourage you to stay tuned. But if somebody's listening to this, maybe they are a financial person or they have a financial advisor or something. What would you say to them? What would you recommend in terms of this concept if they're not familiar with it?
Well, I think first and foremost, as you mentioned, is you have to research, you have to look at it, and there's nothing better in regard to being able to go to your website because you have the tools that people can completely get their hands on immediately.
Right, which by the way is yourpersonalbank.com.
And the other thing too is, we're not competing with those financial advisors.
Right.
I mean, that's really what it boils down to. We're not. This is completely something separate.
I call it icing on the cake.
Yes.
Keep your financial advisor.
Yeah.
I don't care.
Right.
But add some additional interest or positive arbitrage over and above what you're already doing, right?
That's it. I mean, we're just allowing them to be able to have a opportunity to work and utilize a bank and a personal bank for themselves. I mean, that's really what we're,
and earn an
providing
extra
for them.
2 or 3% on your money.
That's it.
Over and above whatever it is else you're doing.
Yep.
So for more information, of course, contact us at yourpersonalbank.com or toll free 866-268-4422. In the previous segment, I misspoke. It's 866-268-4422. Stay tuned in the last segment here because we're going to ask Richard a couple examples of some clients he's working with on the Your Personal Bank concept.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we have a special guest, Richard Goldberg. He's been with us this entire show, and thank you for joining us, Richard.
This has been great. I really, really appreciate and enjoy being a guest today. Absolutely.
Awesome.
Yeah.
And I invited, as you can probably tell, Richard's got a lot of experience in the financial world, over 20 years. You've worked with probably hundreds of clients, I would guess, in that time, easily.
Yes.
And was recently introduced to this Your Personal Bank concept. Kind of told the story about how you were introduced to the idea, what you're doing with it yourself now. If you missed that, go to yourpersonalbank.com, our website. You can listen to this interview or any of the previously recorded shows. But what I wanted to talk about in this segment with you, Richard, is I know you're working with some clients today, or recently, I should say, on some situations. What do you got going on with some folks right now?
Well, one of the things in doing reviews and talking to clients, kind of getting a snapshot of where they're at, I have written some policies that while they're permanent life insurance policies, most of those have been using an indexing strategy. And, when I was introduced to the personal bank concept, Your Personal Bank concept, I think for me, one of the biggest things that I found is, they're not so much in the accumulation phase. They're now in a situation. These people are 60 plus,
Okay.
and now they're in a situation where they're looking at and saying, "Hey, I've got this chunk of money.
Right.
How can I utilize it in a way that can continue to grow
Right.
in an environment where I don't have to take a risk?"
Right.
And this is where I introduced the concept.
Sure.
The positive arbitrage and what have you. And I
Right.
think for me at least, or for them, they've just, very excited about it.
Yeah.
Because initially, I was presenting with the idea of, hey, we can utilize the correlation between the bank and the policy to eliminate the premium payments.
Okay.
That was the initial way in which we were going to do that.
Okay.
But
Which it can work that way.
it can work that way, but
Sure.
in talking to you and getting more tutelage and understanding and
Right.
learning, and checking in regards to these, bringing you into the fold in regard to these situations, they see now, like, well, why don't I just continue to fund these?
Right.
As I'm continuing to fund these, I'm still going to see 5.75%. We're using that
Yeah.
dividend because
Good rule of
that's
thumb.
the company that I've been using. But
Well,
they're a different one of the companies.
Yeah.
So we're just
Exactly.
using that for sake of example for arbitrary purposes in this conversation.
Yeah, I tell folks, just so you
Yeah.
know, right now we got companies paying between 5.75 to 6% dividends.
That's right.
They've been paying that for the last 25 plus years. Literally have never missed a dividend since before the Civil War.
Yeah.
That's powerful.
Absolutely. And as you mentioned, so mutual companies.
Sure.
So they're,
These are huge.
and they're looking at what they're doing is they're
A+
looking
rated,
at
all that.
and they're looking at long-term
Right.
risk. That's where they live.
Some of them have even come out and said, what's exciting,
Yeah.
and I've been sharing this recently, is some of them come out and said we're going to pay our current rates for the next year or two going forward, like 2022 and 23 even in this low interest rate environment. So it kind of gives you an idea, and that's, I think, extraordinary given the low interest rate environment we're in. So it gives you an idea of the kind of reserves, cash reserves, and financial stability these companies we work with have. So,
Yes, absolutely.
But going back to your example,
Yeah,
for your clients.
so getting back to the client, so in this case, we looked at just the idea of being able to grow the credit line, not having to touch it.
Okay, right.
By them continuing to fund the policy.
Right.
And then we even talked about taking it to the next level, in my view, of using it to pay expenses.
Yes.
And let's talk about a couple other things here. Let's talk about the tax. Obviously, we have huge tax favorable benefits that I'm not going to get all the details.
Sure. Right.
But that can affect in regard to how much your Social Security is taxed.
Right.
It can have implications in regard to where you're going to be down the road. I've got people that are making less money in their retirement and paying more taxes, and they can't figure out why.
Right.
And
the way the tax code is structured, exactly.
The tax code, and they maybe then have the deductions and what have you.
Right.
But we're working on tax. That's one of the
creating a tax-free bucket
tax-free money.
That's what I tell them.
Can't get any better than that.
Right.
So that's where we've gone into scenarios where we've talked about where other money's going to come from, where they have money that's coming from their a company 401k, where money's going to come from another sale of a property, and this whole idea of utilizing your personal bank to help them continue the tax favor and to continue the positive arbitrage.
And since you brought that up a couple of times, Richard, if you're concerned about potential tax rates being high, or taxes being higher in the future, which I think is a very valid concern today.
Yes.
Given our current administration and all the stuff that's going on and the debt level that our country has, well, creating a tax-free bucket of money is just financially smart.
No doubt. Let's face
that option.
Yeah, let's face it. Taxes today are still for sale. Or they're on sale, I should say.
Yeah, they're on
so another client I have is they're taking the money that they have in their qualified plan, their 401k,
sure,
and they're paying the taxes now and contributing right into the
much like a Roth
policy,
conversion.
like a Roth conversion.
Many people are familiar with
the only
that.
difference with the Roth is that look, when you're older and you're looking at risk tolerance, it's a whole different world. The ability, we're not in the accumulation phase now.
Right.
We're in the protection phase. We're in the distribution phase. We're in the phase of, as once again, let's make sure that we keep this money. Let's not take risk.
And that's where positive arbitrage really shines.
Exactly.
Because it means there's more money for distribution.
That's exactly right. And I know and this is
Yeah.
another discussion that we have,
Sure.
maybe you'll have me back, but I was thinking in regard to, because you even talked about how annuities, income annuities, there's some different views in regard to that, and
Right.
you've kind of enlightened me on that as well. Because, you know, when you think about a big picture, once again, you know, we're looking at money that's tax favored.
Right.
And we're looking at money that you have the opportunity to have positive arbitrage, whether you're going to use the policy and the dividend that's
Right.
going to be paid,
Right.
or if you're going to use the bank and utilize that for positive arbitrage. So
I've done entire shows on this and annuities. Even I was one of the top 10
Mhm.
annuity producers years ago.
Yeah.
In the country, and it's not that I'm negative to annuities. I just think they're, I mean, for most people, a plan B, maybe the second best option. And the reasons behind it, as I've shared with you, typically with annuity, they earn less.
right,
It's tax deferred, means they're going to pay taxes on it when they take it out. Here they won't with the personal bank. There's less liquidity with annuities.
yes,
Here you're typically looking at 50 to 85% liquidity day one.
right,
There happen to be funds available, what they call living benefits, long-term care type of expenses.
correct,
There's a death benefit here for a survivor or beneficiary if something happens prematurely. It's not typically with an annuity. But I think the most powerful thing is you can't produce positive arbitrage with an annuity.
no, you cannot.
And
No.
here you can.
No, and the other thing, so the one other client I wanted to talk about, this is one you and I worked
So
on.
bottom line is,
Yeah.
you know what I do with folks with annuities?
Right.
Not that I don't ever do them, I still
Right.
do. It's if we can't get them in the personal bank.
Exactly.
So
Yeah.
now it's plan B.
It's plan B.
Okay.
Right, makes sense.
Second best thing.
Yeah. So I do want to talk about another client that you and I actually worked on together.
Mhm.
We did
Sure.
a call on, and this is a young man who's 24 years old.
Right.
And I just want to mention this. You know, as I mentioned, typically my clients are 45 to 65, typically
Sure.
in that range.
Right.
Pre-retirees or retirees.
Right.
And this was, I don't really deal with the millennial. I haven't.
I've done with a lot of them actually, but
And that's terrific.
Yeah.
And I think that just goes to show, you know, this particular young man that we spoke with had no idea, wasn't even familiar with anything in regard to
Right.
the concept or whatever.
sure.
And turned out, long story short, turned out to say, hey, I want to start putting money in, and you got to start somewhere.
Right.
And, you mentioned some things where he could see positive arbitrage.
Right.
But what a great, to me,
in his case, wasn't it to knock down the student
yeah,
loan?
to knock down student loan
Debt,
and his
yeah.
car payment.
Car payment. That
Yeah,
was it.
and the thing is like I would never have thought of approaching the millennial market, and now this opens up a door for me to talk to, literally anybody. I mean, when you think about it, right?
Richard, I
So-
have clients that are 18 years old,
Yeah.
literally, and I have
Yeah.
clients that are 79,
I know.
and everything in between.
Yeah,
And the beauty, and that's another common misconception a lot of radio listeners have. They'll think, okay, this sounds great, but I got to qualify for life insurance. I'm not gonna because of my age or health. That's not necessarily an impediment. And in fact, most people think they're too old when they're not. Again, we've got cases up to 79, no problem.
Mhm.
And even if that's age or health doesn't allow them to qualify,
Right.
like my mom's, we do what's called a family legacy case.
sure.
So where we have the kids or the grandkids be the insureds and the grandparent or whatever is the owner, and they control the money. They typically their trust owns it. We involve the trust for that stuff, but they own it. They control it. It's their money, and then they can pass it on tax favored to the next generation. If we do it right, it's tax free, folks.
Yes, I mean, you and I just had a conversation of, I had someone that unfortunately passed away,
Mhm.
and they're gonna, the beneficiary, the other spouse, is gonna see a pretty sizable amount of money.
Right.
And, I'll just kind of let you kind of finish that sentence, and, you told me basically what?
Well, he's going to receive this. The beneficiary is going to
Right.
receive this money tax free because
Tax-free.
it's a death benefit proceed. Why invest that into something that could become taxable in the future? Why not continue to grow the money tax free, access it tax free, and then pass it on to their heirs tax free? Folks, that's what the wealthy do. Okay.
Yes, they do.
They absolutely is how they operate.
Yep.
Because when you're a higher net worth person or a higher income person, the higher those numbers are, the bigger deal taxes are. Right?
That's right.
And just because maybe you're not in the top tax brackets doesn't mean it's still not significant to you. Right?
Absolutely true.
Yeah.
I think the last thing I just wanted to mention was if you look at, we talked about the banks,
Mhm.
and if you look at Wells Fargo or you look at Bank of America
Right.
and you see their profit and loss statements, and that's public information, it's
Yep.
available. they have more money invested in permanent life insurance
Yep.
than they have in real estate holdings.
Yep.
So you
That's
think
true.
the banks know what they're doing when it comes to investing? I would hope so.
I share this all the time in our bank board meetings. We talk about insurance as part of the portfolio for the bank on a regular and consistent basis. Banks understand that high cash value insurance policies, actually there's a term for it, it's called BOLI,
Right.
bank-owned life insurance. There's billions of it sold every year, and it's, by the truckload literally, and they understand it's called Tier 1 capital, which for FDIC is considered the highest, safest capital a bank can own, and it's safe, it's guaranteed, it's tax-free. It gets a higher rate of return than anything else out there with guarantees today. Banks love it. And I say, look, you can love banks or hate banks. I don't really care, but we can agree they're savvy about money, right?
Absolutely.
And can you learn something from them?
No doubt about it.
It's part about being independent and learning from
Absolutely.
mentors.
The executives at those banks, they didn't get where they are by not knowing what they're doing. So
No.
Yeah.
And the insurance companies actually have more money than the banks. So
Yeah.
they're doing something right too.
That's
The other part of it I tell people, and I share that's one of a lot of people don't, the other question, they're shocked when I tell them, yeah, there's insurance companies out there paying dividends of 5.75%, 6% dividends even today, and have done so for decades and, since the Civil War. And they're shocked by that. And I say, you have any idea what insurance companies actually make? You look at a financial report, an annual report, 9.5%, 10% is the norm.
Yep.
Annually. And I tell people, people are surprised by that. I said, look, if they're making 9.5%, 10% typically on an average typical year, can they pay you 5.75 or 6?
You can see where that spread is, where they can give you the
and make a profit
yeah,
on
absolutely.
billions of dollars
Absolutely.
every day of the week.
Yep.
All right, last thought, Richard. We're going to wrap this up.
I just hope you have me back, because this has been
Yeah.
fun. It's
I'm
been
glad
great.
you enjoyed it.
Yeah, it really, really has. And I just want to another kudos to you. I don't want to to toot your own too much. But I love being able to
thank you.
to have this opportunity to work.
Let's
with
leave
you.
it with this thought. If
Yeah.
somebody was looking at this idea
Yeah.
maybe for the first time, or
Absolutely.
an advisor or a client, potential client, what would you say to them?
Here first and foremost, they obviously would go to your website and start there.
Yourpersonalbank.com.
Yourpersonalbank.com.
Right.
They can call me direct
What's that?
at
What's your number?
602-488-2379.
Okay.
And we can start the discussion.
Perfect. All right. Well, Richard, thank you for having us on, or joining us today. Loved having you on here. And if you want more information on any of this, again, like Richard and I both said, go to yourpersonalbank.com. You can listen to this interview or any of the other shows that we've done over the last several years. Contact me at toll-free 866-268-4422. And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.